Hi everyone, this is Brother Willis. I hope everyone's had a great week. I just wanted to talk a little bit about Unit 7. It's a little bit different than what we've been doing the past few weeks with the time value of money. So I think it's worthwhile to talk about it. Unit 7 is combining financial and gospel principles to achieve temporal and spiritual success. And I think there are a lot of ways that financial principles can be related to the gospel. So I've been asked that question a lot. And it's really a pretty easy question to answer when you think about it. So here's our course overview. Looks like we're a little over halfway done, so great job. Keep up the great work. So let's talk about gospel applications for finance. I think a lot of these are common sense. We've probably heard of these or thought of these before. So the first is provident living, which means living within your means. Believe it or not, that applies in business just as much as it does personally. The second one, wise use of debt, that also applies in business just as much as it does for us as individuals. So with business, a lot of times they do make an effective use of debt. I think the key is to have the proper balance and to avoid excessive debt, and that's a lot of times easier said than done. The third, ethics and governance, and there are laws that were passed as the result of some corporate scandals, which I'll talk about in a minute. They're called Sarbanes-Oxley, or SOX for short. It's called after the two senators that drafted the bill. So this brought in new legislation about rules and regulations that companies had to follow in order to be listed on one of the stock exchanges. So the next, be honest in your dealings. We've heard a lot about that. It's throughout the scriptures as well. It talks about being honest, the value of hard work. I think we can all agree that working hard is going to benefit us both temporally and spiritually. And then also community service. So provident living. Provident living applies in business just as much as it does for individuals. If we go back to the 2009 Great Recession, the stock market lost half its value. So the Dow Jones Industrial Average went from 14,000 to 7,000. That was the biggest drop in history except for the Great Depression in 1929. So as a result, many businesses and individuals filed bankruptcy and banks foreclosed on homes. The Great Recession was caused in large part by the misuse of credit. So credit was too easily attained, both for businesses and individuals. Businesses and individuals were buying things on credit they could not afford, which was providing false growth to the economy. So some things that were happening, like stated income loans, that's where you go and apply for a loan. And they ask for no verification or documentation of your employment or of your earnings. You just apply for the loan, they check your credit score. If it's good, you can put that you're earning whatever you want. You can say you're making $2 million, and they won't ask for verification of that. Another one is reverse amortization mortgages. That's a bad practice. That's where the principal balance on your mortgage actually grows. You're not even paying full interest. So one might ask, why would a bank or an individual even do that? That's because home values were appreciating so quickly, and the average loan is outstanding for 3 to 5 years. So banks and individuals feel that before they would get upside down, there would be enough appreciation to cover that increase from the principal balance. So here's a real life example that I experienced with a company I worked for. The picture here is the office that we occupied. It's an A-list property. But we were an engineering and contracting firm. There was really no business purpose at all for us to have this building. We rarely, if ever, had any customers come visit us here. They always came to our branches, which were in areas of town that were not nearly as nice as this. So if you look at our sales, they're in millions from 2008 to 2009. You see we went from 200 million to 70 million, a huge drop. A big part of that was the Great Recession that I was just talking about. And as a result, we had to cut expenses drastically. So one of the things we did is we subleased this property and moved into a building that we owned in really not a very nice part of town in downtown Phoenix. So what this did was allowed us to save a lot of money, because we really shouldn't have been in this building in the first place. If we hadn't been, then we could have saved a lot of money, because this building was costing us about $100,000 a month. And so by moving out, we were able to save a substantial amount of money. So the Council of Church Leaders on Debt was summarized by Elder Robert D. Hells. So for homes, the church has counseled us to be modest. They're usually good investments, and they have tax advantages. So it is appropriate to have a mortgage for a home, as long as it's done wisely. School is an acceptable use of debt, but I would add, try to avoid it as much as possible. Try to finance it yourself as much as possible. Car, it's okay if you need to, but make sure it's basic, and try to avoid, if possible. Credit cards, never, and always pay off the monthly balance. If you do find yourself with some credit card debt, there's some great help out there. I would encourage everyone to go to Dave Ramsey's site, which I think some of you have done, and I've read some of your posts. And he's got some great suggestions about how to get out of debt. So ethics and governance. Let's talk about agency problem. That's where managers put their own interests above that of shareholders. Obviously, that's very bad, because the goal of a firm is to maximize shareholder wealth. So let's talk about some of these corporate scandals where managers put their own interests above those of shareholders. So we have Enron, Arthur Andersen, WorldCom, Tyco. You would think that these companies had these complicated, elaborate schemes that they were doing in order to defraud the company, but they really weren't. Enron, for example, they were just putting debts off the balance sheet, so they were not visible to shareholders or creditors. So it gave the appearance that they were performing better than they did. As a result, stock price went up, and managers who had substantial investments in the company profited greatly. Arthur Andersen, that was the auditing firm that no longer exists as a result of this, that was auditing Enron, and they pretty much looked the other way. Why? Because this was a multi-million-dollar account for them, and managers that were working on that account were probably pocketing six-figure bonuses. So you can see the temptation there to kind of look the other way. WorldCom, their executives were just putting expenses on the balance sheet, which was inflating profits and subsequently stock price. Tyco, their managers were submitting falsified expense reports so that they could profit, kind of like getting a bonus. So management incentives, those are things that management will do in order to profit. So like if you have a salesman that is going to maximize his commission if he hits a certain level during the year, if he sees in the fourth quarter that he's not going to hit that level, he might have the incentive to kind of push sales off until the next year so that he starts off ahead. Well, that's not in the interest of the shareholders. If this was your money, you wouldn't want them pushing sales out to the next year just because they know they're not getting a bonus this year. Another is tax avoidance, so taking cash under the table or doing other things that are unethical in order to avoid tax. Accepting bribes. So a lot of managers or people will bribe other companies in order to get them to use their company, and thus they'll get bonuses, kind of a kickback, if you will. And all of this kind of goes to misrepresenting financial statements. The value of hard work, just a couple of articles that I'd like to point out here. One is from Elder L. Tom Perry about hard work, and the other is from award-winning writer Irma Bongbeck. So I would highly recommend following those links and reading those articles. Lastly, community service. So here's a good example of a company that I think does a great job with community service, Honeywell. So here's a link here that you can go read more about that if you'd like. But when you think about maximizing profits for a firm, there are two ways that we've talked about, either increasing sales or decreasing costs. Well, community service really does neither of those, right? You're not necessarily increasing sales. If anything, you're increasing costs in order to do the service. So it does erode profits. But the thinking is that maybe in the long run, it creates goodwill and branding for your company so that it will return to you in future years in the terms of increased business. But even if it doesn't, I think it's a good practice for businesses to give back to the community because those communities that they exist are the ones that are buying their products and services and helping them prosper. So good luck this week, and let me know if you have any questions.